Good evening, ladies and gentlemen, and welcome to the 192nd event of the Chennai International Center. So, we started in 2016, as some of you may be aware, that in a journey of about 7 years and 2-3 months, we've tried to cover as much ground as possible in conducting events, particularly covering diverse range of subjects. So we don't restrict the ambit to the normal commerce, economics, business oriented discussions, but travel beyond that to culture, arts, anything that stimulates the intelligent quotient of the brain is what we aspire for in the Chennai International Center. Now, today is a very unique and a different type of discussion. And before I get to the speaker, I think all of us have been grappling in our way in which we conduct our lives, particularly in the way we deal with investments. Whether you are very well informed, whether you are not well informed, or whenever you start your career also, the main problem that agitates your mind is, how much do I save? How much do I invest? If I need to invest, where do I invest? How do I invest? What should be the ideal rate of return? I am just making some very bland motherhood statements. But behind every investment decision, it is not that every investment decision is intuitive. Some are, and some intuitive decisions pay off, but not always. So the majority of the decisions, you need to apply your mind in a very analytical way, do your own research, consult, probably deal with so many people who are good in the subject and take their inputs, whatever. In fact, in the good old days, I remember the moment you knew somebody was investing somewhere, you go off, just follow him and then hope that things will pay off. But times have changed. So today, it's a different world. It's a highly fast developing, technology oriented world. So in the changing dynamics of the marketplace, how do we deal with investments? In fact, his subject is changing nature of investment. I was trying to modify it by saying changing nature of investment and changing nature of the investors also. The investor profile also is considerably changed. The age profile has changed, the demographics have changed, the mindset has changed. So Karthik Ranganath is a very seasoned professional. He's had a very distinguished career, an IIT Madras product, IIM Bangalore, very deadly combination, IIT, IIM, as all of you know. Most of them are very, very successful, and Karthik is no exception. And he has started a very interesting startup. Should I call it startup or it's a mature company? I don't know. People use this startup in a very different way today. But it's a startup called Thorough. And basically they provide inputs beyond financial numbers to help informed decision making process to fund managers, to analysts. They are a quasi research organization providing non-financial inputs of various forms. He will go through the details, and this will be a very important input or a catalyst for informed decision making process in the investment decision. That is the way he has positioned his startup company. In fact, we were just discussing before the meeting started, what is so unique? He will explain the uniqueness part of it. I am not going to do it. But today, there are a lot of people providing data, information, analytics, tools, enablers to make decisions. With all that, investment decisions can go wrong. It will succeed, it may go wrong also. But the purpose is not to analyze what decisions have gone wrong, what decisions have succeeded. That's not the purpose. The purpose is to enable the platform, and he will provide you the basis how his platform is working. So this platform is a groundbreaking visual discovery platform that provides ready to use and up-to-date market intelligence and business metrics. The motivation of Thorough is to distill out long-term signals from the noise, from the data deluge surrounding us. Data deluge. We are overwhelmed with data. We don't know which data to take, which data to jettison. That is the biggest challenge today. So Thorough's insights are prepared from over 25 million data points collected daily from unstructured public data sources. thereby solving the data and machine side of the problem solving in investing. Karthik will now speak on how all of us can leverage data and technology both to become better investors. He is also joined by his wife, Mrs. Karthik. She is also a co-founder, and in fact somebody was saying behind every successful man there is a woman, every successful woman also there is a man. So it works both ways in this, and they were classmates, and they have started this startup together. So good luck to them, but I now leave the floor open to Karthik, and then we'll have our usual Q&A session. Karthik, please.
Thank you, Anand, again for the introduction, and all of you at CIC for inviting me to speak. Good. So what I'm going to do is talk on really three main topics today. I think Anand outlined some of the thoughts that I have. One is to distill and think about how we make our own investing decisions. That's number one. I'm going to talk about the fact that what are the challenges we face while we make them. And third, really say how technology and data can really alleviate this problem, right? And he said, I've been an investor all my life. That's, I think, is what I call code for saying that I'm a jack of all trades, king of none. So I might not have anything which tells you exactly where to invest, but I will give you enough pointers from psychology, finance, data, technology to actually say how we can do better investments, right? Standard disclaimer applies. I'm not an influencer, I'm not an RIA, so please don't take any of the data points and examples that you see on the presentation as any of them as recommendations. I just think it's I just put the standard disclaimer about, right? So let's get going without too much ado. How do we make decisions? I think Anand in fact used the term rational. I think most of us would believe that we are rational investors. Some of us might say we are gut, instinct, impulsive. Some might say we all look at risk and reward. But having had the benefit of actually looking at a lot of investing decisions over the last 20 plus years, I want to take you through how we actually end up taking investing decisions. I'm actually going to use an ad to actually take you through this. It's one of my all-time favorite ads. It came around the year 2000, but I think it's very, very, very instructive on how we actually go about doing our investing exercise. So let me just quickly, just give me one moment and that comes right. I'm sure it'll warm your heart when you see this.
Mommy! Mommy!
Huh?
मेरा इसमें second half.
Let's celebrate.
गुलाब जामुन.
MTR gulab jamun.
अरे वाह गुलाब जामुन किस खुशी में भाई
Second आया है रेस में.
सेकंड नॉट बैड वेरी सॉफ्ट कितने रनर्स से चैंपियन
दो.
वेरी गुड दो अबे
MTR Instant Gulab Jamun Mix अब 50% ज़्यादा pure and perfect.
I'm sure many of you have seen this ad, right? It was MTR's ad, I think, in the early 2000s, and it was something which I think, at least I love this ad. I'm sure, what do we have what can you gain from this ad on decision making? First thing, outstanding, adorable kid. I think even if you're not the kid's parents, you loved him, right? And I think the parents must have loved him even more. What happened really? The kid made a statement, right? That he came second in the race. The mother believed him, right? Straight. Believed him. Said, let's celebrate it, let's make gulab jamuns. The dad came, the dad also believed it. He also ended up eating the gulab jamun. Just around the end, he checked the truth, right? He said, how many people ran the race? The kiddo says 2 and he ran away, right? So most of us, by the way, decide very similar manner, right? We hear a statement, we believe it, we perhaps even act on it, and then, if required, we actually check the data, right? And this is something that happens over and over again, especially if you hear it from people who you like or people who you trust. In this case, it was a kiddo who people, I'm sure they liked and trusted, but if you hear it from people who you like and people who you trust, you automatically end up believing it, then you act on it and you check much later. Why is this the case? This is the case because humans evolved in the jungle, right? it paid us to actually believe what was heard. If you heard a rustle in the bush, it was likely to be a lion. You actually wanted to believe it, immediately. If you actually try to check the data of whether the lion is there behind the bush, you perhaps die, right? So we are wired to take decisions instantly, right? And this is for those of you who have read Thinking Fast and Slow from Daniel Kahneman. This is exactly what he says. This is system one in operation, right? But does this happen in the investing world? I'm sure many of you were saying this is all okay. This is a kiddo with two the parents. It doesn't happen in the investing world. And I'm going to actually give you an analogy from the investing world. And correct me if any of you think otherwise, and feel free to ask questions as I go by, and it's happy to talk. I believe the kid is the management, right? He's loved by many CEOs are loved by investors, by the press. They are really the center of all attraction or attention. And here is this kiddo who is actually really playing the role of the CEO. He put out some data, which is like the financial data, which is like the conference call transcripts, which is like the investor presentation. He puts out some data. Right? The mother is the brokerage firm. And she applauded, right? Immediately, right? Wow, what a great job you did. The dad also, he's the poor guy who's an investor, right? And he actually also buys into the stock perhaps by eating the gulab jamun, but checks later, oh my God, did I actually buy the right stock? And he finds that actually, this is not actually the case, right? For those of you who think that this is still far-fetched, you don't agree with it, let's try to look at something which is closer to time, right? What happened to Byju's? You can think of the little kid as Baiju Ravindran. He didn't even present the financial data, right, Anand? He didn't even, FY22 results are not yet out. So he did not even present the financial data. But investment bankers were still saying it's the best, business in town. Investors chased him. Now, of course, they're chasing him for the fact that there is no financial returns, right? And this is exactly what happens. So this is a really true thing of what happens in the real world. But what is the right way? The right way is you hear, check, and then act, right? And that is the rational world, and that is a very, very difficult thing to do. Even this framework requires a little bit of update, but we will actually, work with this for the time being and then update it over time, right? What do you guys think is actually the best question in the ad? Anybody? The best question was how many people ran the race, right? The dad asked. It's a beautiful question. Why? Because it clarified what is the context. How many people ran the race? 2 people. You're second out of 2 people. So competition was low. The cohort was 2 people. And it established potential. Whether the kid was the next Usain Bolt. Right? That he is not was very clear. And we were actually able to establish each one of them very beautifully. Right? And that's what I think most of us miss, which is to take this context of saying, what is the best question you can ask, which establish the context of somebody's performance, right? When a company says they performed X% or Y%, are you able to establish the right context in which they actually deliver those results? And that is actually the most important question that we have in the investing world. So, most of my conversation today, talk today will, talk about how we actually ask better questions in the investing world, right? So we talked about, the problems that we have in our decision making, and we're going to say how will we, and the challenges that we face, we're going to talk about how we are going to alleviate them, right? So let's, so maybe just go back to the investing world, meaning just first principles for a few minutes before I delve deeper into how technology can help us, right? And this is Ben Graham, the guru of value investing. And what did he say about, value investing or any investing? An investment is one where on thorough analysis gives safety of principle and a satisfactory return. Anything which does not meet these requirements are pretty much speculative. Fairly encapsulates in a smaller thing, I would say, good business. What we need to figure out in good investing is good business run by good promoter with some decent growth at the right price. Very simple, right? This trifecta, quadfecta is practically impossible to get today in today's markets. If you have the right promoter and the right business, invariably you don't get the right price. If it's very fast growing, it's even more difficult. And for us to actually go and actually discern and find out which companies are doing very well, what do? We typically go and pore over many reports, and most of them could be transcripts, annual reports, financial statements, presentation, brokerage reports, leads to what economists call a data deluge, right? What do? They're all just actually one type of data which is getting represented repeatedly in different forms and fashion, right? So in fact, and as a result, what we have here is a very inside-out view of the company, right? Everything is financial data provided by management teams, and management teams have actually, put it out into the market, and that's all very inside-out view of the world. But what we need to do, or what our learning was from the, in the same slide, correct? Okay, sorry, right? Learning from the dad in the MTR ad, right? What did he say? He said evaluate context. And forex context could be evaluate how the company performed against the larger market context. So if it's Maruti that you're looking at, not only is Maruti the only listed four-wheeler firm in the country, but the fact is you would like to know how Kia and Hyundai and others performed and how did they perform against that. That's a very important parameter for you. Check if profit pools are shifting away. An example could be, today there is UPI, there is credit cards. And the profit pool that is available with credit cards shift away to UPI. It's a question that we have, and it's something that we need to answer for ourselves. What do we need for all this? We need what we call data which goes beyond financials, which is the all data, right? Like the data which, which the dad got from the kid, which is that how many people ran the race, which is external data, which is what I call the outside-in perspective. We need to access that. And how do we access that? In fact, even as far back as 1957, there was a person by the name Phil Fisher, one of the greatest investors of all time, who said, look at what you need to do is conduct due diligence. And when they said conduct due diligence, he said, meet with your customers, meet with trade association, talk to old employees, go beyond financial statements. Financial statements are important, but go beyond financial statements to get more color and texture about the businesses that you're investing in. And that is true of even, and this was even formalized even better by, Michael Porter in 1979 when he said, and most MBA students would have gone through this at some point in time where they said, here is a case of, what is the threat of new entrants, what is the bargaining power of customers, suppliers, what's the, who are the current competitors, or what is the set of substitutes that we have, right? And if you analyze a firm from these aspects, you not only know what is happening to the firm today, but you also know what is happening to a firm going forward, right? And that's very important for all of us, right? But the challenge with all this is external data, and we need to somehow get to external data. And like the earlier slide which I talked about, what did he say? Talk to employee associations, talk to trade associations. It's a very time-consuming, onerous exercise. And typically the challenge here is, in many cases, is likely to be anecdotal. So when I started in the investing world, my first exercise, I looked at an FMCG company, and I was asked to go and check out supermarkets and supermarket aisles to find out whether the product was placed enough and what shelf space did they occupy. Now, I can do it for one supermarket, two supermarkets. Can I do it across the country? Can I do it even across the city? Impossible. Invariably, scuttlebutt, the terminology which Phil Fisher used to say, how can I get better information about the, businesses that you're investing in, turns out to be a very anecdotal exercise, right? And we want to change all of that, right? And that's where, the question immediately comes, can one use technology, right? And that's the key question. Can we use technology to better understand, do a better scuttlebutt, right? And the term that Phil Fisher, really propounded, right? And the interesting part was, this question was actually answered in the affirmative, at least in the US in the early 2000s. And a very, very interesting, case study was made by one fund manager. And this was a time when almost all retail chains in the country were on the onslaught of Amazon and other, online retailers, and they did not know if footfalls were increasing or decreasing, right? So the fund manager, very smart guy, who's a very tech savvy guy, decided saying that done with financial data. I've had enough with financial data. Let's do something else. He said, can I have satellite images of parking lots? The answer was yes. Google was actually available, making satellite images of almost all parts of the US fairly cheap and with a time lapse of just around 7 days or so. Right? And he could actually access those. He ran an image processing algorithm on top of one of Walmart's parking lots, understood what percentage of the parking lot was occupied, took a fairly smart guess on whether footfalls was decreasing or increasing. Right? Very, very different use. He didn't use data which was inside financial statements, but he took what was happening to footfalls. So the one good part is, one is the lead indicator. It's like tells you how the footfalls are likely to be. Number one, it potential. The second was it tells you something other than just financial data, and that's very, very powerful. And even more beautiful was the fact that he did not have to do it on one or two Walmarts, but he could do it, and I mean, it's using Walmart as a thing for all retail chains, one or two retail outlets, but he could do it across the country in different states and actually have a sample which was almost in the thousands, right? And that's a very powerful, data point when you say that it is actually only 5 or 10 vis-a-vis you have a sample set of 1,000. And because this was completely done out of a desktop and using a computer, where he was actually using, data points to, image processing algorithms to find out what percentage of the parking lot was operational, he could do it repeatedly every single week when new data or new satellite images came in, right? So essentially what happened, right? The Phil Fisher phenomenon, which Phil Fisher said in 1957, talk to trade associations, get external data, talk to all of that. That just went digital, right? You could do all of it. Instead of going and visiting a supermarket outlet to find out if footfalls are increasing or decreasing, he used publicly available data sets to access and establish the same insight. Others took it even further, right? And once, this literally opened the floodgates, right? And, others took it even further. In fact, I don't know how many of you are familiar with a company called Yodlee. It started by an Indian, Venkat Rangan, in the year 2000, 99 or 2000, where it's a very cred-like business where you actually aggregate all the credit cards and bank accounts that you own, put it all together in a single repository so that payments can happen. They had anonymized data of almost 40 million users across the world, right, and across the US, and they could say, where are these people actually spending their money? Was it in Walmart? Was it in Spotify? Was it on Amazon? And so fairly where spend was going, and it's a great insight to know if spend was going somewhere. If the price is right, then it's actually a great investment, right? And so we're able to say where is spend going, and all this was really anonymized data that they were able to. It's much like cred, and in fact, I would say this really opened the floodgates in terms of all data, and today every single fund, almost I would say more than 50% of the funds in the US actually use alternative data, which is beyond financial data, to make their investments, right? And literally all data, this digital data that we talk about, is literally the go-to tool for all fund managers today, right? Every fund manager worth their salt is actually looking at all data. Right? I'm sure many of you have this question now. India doesn't have parking lots. Where do we go for this kind of information? What insight will I get? How can I use this in India? Right? We invest in India, and how do I do this? Right? And that's a very important data point. What Yodlee gave, which was credit card payment data, is also not available in India because of the fact that data privacy norms have ensured that we don't have access to credit card data in this country. So how does it work in India? I don't know if many of you have guessed, but it's actually quite interesting. From around 2019, when we started out Thorough, what we have observed is the fact that there is a lot of external data coming out from primarily two different sources. The first one being regulators and government regulators or industry regulators. They have actually become very proactive in putting out data almost on a systematic basis, monthly sometimes, sometimes even daily. For instance, the CEA, today the Central Electricity Authority, puts out data on the output of every power plant across the country every single day, without fail, right? Except for COVID, I think without fail they'll be actually putting out those data. Right? So we fairly rich data is actually being put out by regulators, and that actually is a very good form of understanding how businesses are doing. The second one is companies themselves, by very nature of becoming what we call digital, have become very there's a lot of data available. Give you an example. I talked about the FMCG supermarket aisle walk, right? Which to understand what product is occupying shelf space. So is Marico's products, Parachute and Saffola occupying shelf space? We used to do physical checks. Today perhaps we can replace that physical check with what we call as a online check, right? Walk the digital aisles of an Amazon, walk the digital aisles of a Flipkart to actually understand which are the products which are actually selling in the market. And I'll show you examples. And for say same thing, right? If you want to understand occupancies of airlines, you don't need to talk to a travel agent anymore. You can actually look at some of the OTA sites every single day. You will get an idea of what is happening to prices, what's happening to occupancy, and whether yields or per seat mile are actually going up or down. So all this give you a very, very sound understanding of how businesses are doing, and it is possible to extract this digital data today from what is available in the public domain. I want to make a very interesting, the difference here. So all this is public data. This is not what we call as published data, right? So published data has a form, has a certain structure, but this is public data, right? So public data is by its very nature is unstructured, dirty, difficult to handle, right? And there is a certain amount of skill required to both collect the data systematically every single day and actually use this for investment decision making, and which I think is what we will talk about going forward, right? Let me just go through the next slide. Yeah. So what's the kind of digital data available today? And we have data literally about freight, about port, exim data, store counts, job listings, you name it. Except for credit card data and which is because of data privacy norms is not available in India. All this data is actually available in India too, right? More interestingly, what we realized is over the last few years, the kind of data available to us to actually do better investment decisions is only increasing. It's not decreasing, and more data points actually are coming to the public fold, right? So any questions till now? I'm going to take a few examples now to just take you through how digital data can actually help us answer some of the questions that we have a little sharply. Is that super?
No matter the information explosion is so much, still we get trapped in various ways. For example, the sudden and dynamic changes like income tax rate, and again Reserve Bank is coming out strictures against Paytm and all. So this is totally dovetailing everything. Though we have got a lot of information in media and all other things, and in a structured or unstructured manner, and using our own intellect to decipher the information, still these types of sudden developments, throw everything out of here.
Nobody said what should I say? Investing is it's a probabilistic exercise. There is a probability of losing money at all points in time, right? It doesn't matter which company you talk about. In 2015, you invested in Nestle. You had the same problem, right? Maggie created this problem. You could have lost money there. So there is an element of risk which is there. The idea is, can we improve the outcomes and both the probability of those outcomes? Can we have a better knowledge of them with the data that we have? And that is what we endeavor to do. So we make the probability of loss as small as possible, so that's really our whole exercise. But nobody will ever tell you that this is a sure shot investment. That is clearly a scam. If somebody tells you this is a sure shot
From the
investment.
company's perspective, they don't want to reveal certain things. These are all the things like which they don't want to show it as a gray area, which will affect their own image in the
You
market.
hit the nail on the head, right? Which is why, because companies and management don't want to reveal everything, or they want to, put out the best picture, right? And all of us, we're all humans, right? You ask me, I'm putting out the best image of myself here, right? And let's accept that. That's true for every one of us. So it's actually pays to actually go and look at other points of data, the external data as I call it, to actually say, is it a good investment or not, right? That's. So I'm going to just pick up two examples. I'm sure I gave a lot of gyan on that we can use the digital data. Can we just walk you through the steps of how to do it, right? I'm going to take you through something in the cards industry, right? And I'm going to go back to that framework which we had, which is the Porter 5 first, right? And what are the questions that all of us have when it comes to cards today, right? Who's gaining market share? Is the new age banks taking away share? That's one question that we have. The big one, right? The elephant in the room is UPI going to become the most important mode of payment? Will credit cards stop existing? Yeah. Customers paying on time, right? Because you can take credit cards, are customers paying on time? And I think if you take a recent news item, the person said there, what is the impact of RBI increasing risk weights? That's a really near-term problem that is just raising the thing. Yeah. So let's look at how we will attack this problem with external data. And I'm not going to look at any of the data which is, financial in nature. We have one listed company which is SBI Cards. There is ICICI Bank, which has a large cards business. So does HDFC. Let me see how we can answer this question with just external data, and how we'll walk you through step by step without the technology interface, but how you'll obviously understand how we can speeden up the process with technology, right? Again, this is standard disclaimers apply, which is that the analysis for illustration only, right? Let's get going, right? This is a report which comes out every month from the RBI, right? And this is ATM card statistics, POS, what is the spends on different credit cards, how much is UPI spends bank-wise.
Every month.
Every month, right? And this data is available. It's public data. It's being in, yeah?
No payment, anything.
Nothing, no payment, nothing. The RBI actually publishes this information, right? This is one snapshot of what is happening just today, right? This I think was the December data, right? December data. I think this was the December report, right? And we have this. But like I told you, what happened? Just go back to the example of the parking lot. It's not one data point which matters to us. We want to know how is it changed over time. So how do you do this? We can actually stack up all the reports, right? There are multiple reports. There is actually, this report is there for the last almost 4.5 years or even more. You can actually stack up these reports. Now this, as you realize, is a good, lot of interesting quantitative data. But having said that, they're actually extremely unstructured, simply because you will have Bank of Baroda one day, you will have Bank of Baroda Limited on another day, BOI on another day, Bank of India on another day. But having said that, this is fairly decent data, which if you can aggregate over months, over the last 48 months, will give you a very interesting image of what is happening to the business, right? So let's go ahead and let's start doing this, right? And let's use this data point to see whether we can answer some of these questions, right? Which the RBI puts out. And this is all external. I'm not using any internal data at all. In fact, I just wanted to take this report which came out on I think on India Today on 19th October, which said, your credit card swipes are giving RBI a headache, and there is likely to be a significant rise in defaults. Let's test this. Is it true? Because very important for us, right? If you want to invest in the credit card industry, and there is a listed player in the company, right? How would you do this? So let's go back, right? So this data point has data on spends. It also has data on the outstanding credit, right? The outstanding credit card receivable. Now, if you divide one by the other, spend, you have receivable and you have spend, you can find the days of outstanding, right? How many days of outstanding is actually available. And we have actually enabled, just write that in this chart. This is available on our platform too, but I just pasted this chart here. tells you how many days outstanding is there in the entire system on credit cards.
43.
So all the way from December 2018 till now, it's around 45 days. Hasn't moved.
For 1.5 months outstanding.
1.5 months out. And that's exactly what we get as credit, right? We get credit for 45 days. Pretty much, there is a small outs, but that's about what it is. So clearly, what happens immediately is you dispel that fear that was created by this, what I call text, data deluge, noise, and you're able to get what is called the signal. The signal is the fact that there is no change in the amount of credit card receivables. Right? This is what the industry is saying, and I'm used purely external data. I've not even gone and spoken to even one individual from within a bank, right? And I'm able to actually make this, right? And what we have, interestingly, in this chart is it tells you the business KPI. This is not a stock price chart. This is what is happening to the business. As investors, let me tell you one thing which I want to know. You invest in a good business, decent promoter, you will always make money. At a decent price, you'll always end up making money. Even if you make a few mistakes along the way in terms of price, you will make price. But is it a good business? And we are able to actually discern that. Now let's answer a few more questions, right? The second question which we had was, is UPI actually, decimating SBI, the cards, right? Credit cards. And, there is reason to fear that. And in fact, if you take from April 20 onwards, and this is all the data all the way till December 23, which is just a month old, right? You have data which says that 13.5 lakh crores of transactions got done on the UPI platform. Reason to fear, right? And let's look at credit cards. With the same data sheet that I used, I've done this, right? Credit cards are just at a Pidlu 1.65 crores. But the fact is, they're also growing at 25%. Nothing to scoff about, but the business is growing, right? So, doesn't tell me anything, right? Can we actually change the analysis a little bit? And again, I'm going to do this just with public data, right? I looked at what is happening to average transaction size on the UPI side, on the peer merchant, right? And this is again available right from the same report. And if you just have to aggregate it over time to actually find it, you will find that it's 658 rupees. That's approximately how much the average transaction size on the UPI platform is. Compare that to what is there in credit cards, which is approximately 5,500 rupees. Tells you a very deep, interesting point, which is that credit cards people use for large ticket. When you go to EA, you use the credit card. When he goes to your local neighborhood dukaan, which I'm sure we all suspected, in our market, we use the UPI, right? There are two different usage patterns, right? And it is not fungible, it is not competitive, right? And that is how consumer behavior is. Consumer behavior is that people will use credit cards for a certain reason and UPI for a certain different reason. And we are able to get a very...
Cash also for some reasons.
Yeah, I think cash also for certain reasons, absolutely, point taken. And I think the more important point is that I think UPI has actually taken over cash, right? And that is why it's so large. And that's, I think, so what we delivered with, I think, this whole external data that we have just talked through the analysis is a very nuanced understanding of consumer behavior, right? And it's something that we can actually back ourselves to the hilt. I'm sure something might go wrong in still. It's possible that some regulation happens and something can go wrong, like the gentleman said there. But we can say with a fair degree of confidence and probability that this is true. And I will use the word probability repeatedly over this discussion because investing is a probabilistic game. There is always a probability that you lose money, right? And there is never a sure shot investment in life, right? So that's where we are, right? And the last question that we had was that we asked the question: are new age private banks taking share from incumbents? And this is again from public data. We are actually able to see that ICICI Bank has actually taken share, right? They've actually moved from a 10% orbit to almost a 20% orbit in terms of card spends. That's a huge market share leap that they've done. And I think this is, last question that we had was, what is the impact of RBI increasing risk weights? I've used a number called the Herfindahl index, which is HHI, which tells you, what is the competitiveness of the industry. If the competitiveness of the industry is low, that means we don't have too many players in the industry, which is the case in the credit cards industry. people can pass on price increases. So it doesn't matter if RBI changes regulation, increases risk weights, they will be able to pass on these cost increases to end customers. Right? So that's again something that we are able to discern right from. So I think we come back to a very important question here, that should this analysis be static? You've done this analysis once. Let's say some of us might take a call to invest in credit cards. We stop there. We find a good investment and we stop there. Should we stop? No, right? Because profit pools keep changing. The point which I told, which is that credit card spends today, people use credit cards for a different reason and UPI for a different reason, is true today, may not be true a year down the line, 2 years down the line. Consumer behavior, consumer habits might change. We need to track them. And that is why I think it's very important for us to keep tracking this information continuously on a regular basis, right? And this is, I think, the broad, thesis of why I think data and technology are so important to invest in. Now, I'm sure many of you might ask, could I not done this with in any other form or fashion? The fact is, this external data, while available, is very unstructured, painful. One needs technology to assemble this information. The problems which I talked about of BOI, Bank of India, and one player, Bank of Baroda. If you try to bring all of these data points together, so that to do one consolidated analysis, it becomes very difficult simply because you will find that your Excel sheet doesn't work correctly, which is why you need to use technology, some smarts. I hate the use the word AI, but let me use the way AI, to clean this information quickly as we collect it, put it all together, right? And that is what we, do at. So, just maybe give you another example before I just talk about, another example. And tell me if there's anything which is of interest, and let me see if we can actually pull this out very quickly. Before I go to the next example, I just want to leave you with this interesting thought process from a different field, which is that this is a photograph of the night sky, right? And if you take a photograph of the night sky, you'll see through all the stars. It's like checking that one snapshot of the RBI report. It's the one snapshot. But what we did was we assembled multiple reports, and which is when we assemble multiple reports, it's like taking a long exposure photograph of the same night sky. And what do you see when we take a long exposure photograph of the night sky? You will see star trails. Star trails, and if you actually go closer and closer to the North Pole, you will actually see it absolutely circular. Why is that the case? Simply because it reveals the very outstanding truth that the Earth spins on its axis. That outstanding truth actually comes if you actually take a long exposure photograph, right? Which is why it's so important for us not only to assemble the data once, but assemble it every single day and keep looking at the data systematically over time, right? I can go to another example if of interest. I can take you through an example which we use, which is not so quantitative in nature, perhaps from a place like FMCG, and let me take the hair oil industry as an example, right? And I think anybody investing in the hair oil space, and a fair amount of listed players in this space, I think the questions which most people worried about is what attributes are customers preferring, right? What is happening to raw material prices? I don't need hair oil, but for people who, maybe they have a choice between hair oil and hair serums. Which should they choose? Is hair serum taking over from hair oil? Is the new audience actually new age people use, the younger generation or a Gen Z actually use hair oil, or they use hair serums and hair creams? And who are the new entrants? All these questions are there in our mind. Data on this is very sparse, and people have to rely with news items. Now, let me tell you how you can actually use publicly available information to better your investment judgment, right? This is actually available on Amazon. There's something called the Amazon bestseller list, right? And this is data points tells you what are the bestseller products every single day, right? In fact, I'd like to look at this. very interesting data point. It tells you the rank 1, 2, 3, 4. It's updated frequently, which means it's updated almost daily, and it's based on sales. It's not based on likes. It's not based on search volume. It's based on sales, right? So it tells you that in grocery and gourmet, the top selling product on Amazon is Tata Salt. Great information to have, right? It tells you a very good thing about what to see, and it says the third product is Fortune. Now, again, the same trick, right? There's nothing in this. I think once you learn a trick, you use the same trick, right? Which is the fact that you can take one snapshot, multiple snapshots, pack it together, and you then have a very interesting view of what is happening over time to these businesses. Once you assemble that, you can actually do a attribute analysis, which is to say, what are customers buying, right? What are the trending attributes in the space? You can find it's coconut. Yes, it's still coconut. It's not amla. It's not it's not almond. It's still coconut. It's hair fall or anti-hair fall. And rosemary. It's a product which is called rosemary oil, which is actually selling. So I'm sure many of us did not know that rosemary oil is actually a trending product today. This is something you're able to capture simply because you kept your eye on the external data which is available. You can go even further. Because I've stacked these photographs together, I can actually give you a trend analysis. I can say, who are the guys who have the maximum share? There's actually, in this case, there's a company called Soulflower. Soulflower is actually the one who runs Soulflower rosemary oil against two other new players, Avimi, who went on Shark Tank, I think a year ago, and how they have performed against Soulflower. Right? It tells you what India is actually buying. And this is all from the online space. And it's better than any anecdotal evidence that you can get by going to the supermarket. This is what are customers buying, live data. You're getting feedback literally from the market on 10% of India. 10% of India is shopping on Amazon, and you actually get a very strong signal on what they are buying and what are the key trends. And you can even, talked about that. And you can even answer the other question, which is that is hair serums taking share in the category? In this specific case, it is not, but it's something that you're able to do. So just by looking at external data, which is fairly publicly available, taking one snapshot, assembling the snapshots together, and actually looking at the trend, you are able to discern what is happening to the businesses that you're investing in. Yeah. So let me just, and this is on raw material. Let me just sum up, and before I open up everybody for questions, we just scratched the surface on the kind of data available today. One was Amazon. We talked about RBI. There is data from the CEA. There is data from the insurance regulator. Many of the e-commerce companies have who have become listed as everything about their business is public, right, on the platform, right? In fact, for example, if you wanted to understand the number of products on Nykaa, you can go on the website and literally count the number of products that they have and the number of brands and the number of SKUs that they have. You don't need to even ask any question to anybody. So that is the amount of data which is now coming on to the fore, and it is something that you can, but more importantly, I want to actually showcase an interesting point which has happened in the way in which we approach this whole exercise. We actually today collected data before we had a hypothesis. If you looked at what happened when we looked at the way we analyzed the RBI data, we didn't go with the hypothesis saying that is SBI cards a good investment, or is the ICICI Bank a good investment because of its cards business. We didn't go with these hypotheses. The data was there, and we then did the analysis, right? It is a very powerful statement, and it actually comes from, I think what I think many of us would have read at some point in time, Sherlock Holmes in Study in Scarlet, saying that if you actually used, data, if you collect the data after you have theorized, you invariably twist the data to suit your theories. Right? So what have we done? In fact, if we go back to that original framework, we said here, then we said check the data, then we said invest or act. We have actually flipped this thing together around, and we said collect the data, form a view with the data, understand what is happening, then say which is the stock to play or which is the stock to invest, what is the likelihood of this outcome, what is the probability of this outcome. And like we said, right, it's not enough to do it once, but we have to redo it all the time, repeatedly. And that's what you will see in the framework that which I want to actually leave you guys with, which is to say, check the data, view outcomes and probability, check the price and value, which I think everybody does, allocate, and just keep redoing this exercise repeatedly, right? Because investing, like I said, I think when the gentleman asked this question, is an extremely probabilistic exercise. You might get it right now. You might think a business is doing very well now. 2 years down the line, it may not. You want to have the data to actually support this hypothesis. Right? I will end, I think, with a couple of more slides and then all questions from all of you, which is that it's the iconic ad from the 1990s. I love ads, and especially old ones, which is the fill it, shut it, and forget it from Hero. Right? Many investors, and I think value investors especially, have found success in this dictum. Right? You buy a stock, hold it for 20 years, and that's I think might have been true in the past, but I never even believed that it was true in the past. But today, because of technology impacting every business, profit pools are actually shifting very rapidly. The example which we talked about, which is that can it move from UPI to credit cards or credit cards to UPI, is a reality, and we need to monitor the investments that we have made. Which is why I think it's very important for us to actually use external data to make these judgments and actually reduce the risk of not knowing what is happening to our businesses. And I think no presentation on investing can be without a quote from Warren Buffett, right? So, which is that risk comes from not knowing what we do. The idea is the more data we have, the more sharper our investments are. Because we know we are able to better judge both the probability of the event as well as the outcome itself, and that's really where I want to close. Yeah, and take questions from all of you. Any questions? Yeah, go ahead.
One of my friends cautioned me about Harshad Mehta scam. So to avoid those kind of situations, what should I do? And moreover, now every bank or insurance company or mutual fund are having expert investors in stocks. So, and there is also AI coming, artificial intelligence. So if any kind of scam or unknown or untoward event happens, what should I do?
So I think the principles of investing have always remained the same, right? Maybe the way in which we do it with technology today, those have changed, but the principles remain the same. Right promoter. Getting into bed with anybody who you don't trust doesn't work. If you're investing in a stock on your own, you should know who the promoter is. Number one. Second question, right? Is it a good business? Is the profit pool there and is likely to be there for the discernible future? Like we talked about credit cards, right? Is it a decent business? Very important. Is the competitive advantage there for the business? Is it likely to see a decent growth? Is there some semblance for growth? The last one is, are you getting it at the right price? So if you looked at all of this during the Harshad Mehta scam, there will be many businesses which did not have fundamentals, where the promoter was unknown, which were all trading at 100 times earnings. You can check cross against each one of these 4 parameters, and you're pretty much good to go, right? And you say you don't need to actually invest. The idea is, invariably in a bull market, when you apply this yardstick, you will actually find that there are very, very few investment opportunities in your hand. You have to be convinced that those are real, and there are only a few. When everybody, including perhaps everybody on the street is telling you, every party you go, let's invest in the stock. If you just say and come back home and just put the trigger, you're going to get. The idea is check the data, check the promoter, check what the price is, and then invest. And that's the only, that time-tested dictum always works. Nothing else works in investing.
So how do you look at investment in real estate in next 5 years?
So very simple, right? Meaning, I think you can use every.
Properties have reached almost the saturation point in terms of value. You can't expect much more increase in value
Yeah. So I like to use the same yardstick for all investments, right? And in stocks, there is, let's say, something called dividend yield, right? What is the dividend you get at what price you invested, right? There is something called a dividend yield. The flip for that in the real estate market is rental yield, right? What is the rent for the property value?
Normally hovers around 2% to 3% of the value.
Perfect. You hit the nail on the head. It's 2%, right? So look compare a real estate investment to a stock investment. And let's say I'll take Nestle. Nestle. Will the number of Maggie packets sold in the country change? Will it increase?
But the price is going up. If you see the when
let me
you
finish.
visit the supermarket, the price in the every cycle, with every 40 days you can find the price increasing.
Of Maggie or
Maggi, any consumer product.
so great, right?
Any-
So if you're an investor in Maggie, it's a great thing to be when somebody takes a price increase. You should be very happy with it. Your dividends are going to increase over time, right? It's forget it as a consumer. So you can actually think about. So price increases can happen. Volume of products. Given that India is actually, we are entering into a baby boom by generation, you should find more consumption of Maggi, more consumption of Cerelac, right? So which means that not only can price grow, which you said already that there is inflation in terms of prices. So the price per unit of Maggi increases, the number of Maggi sold increases, and you're able to increase, and you're able to then see maybe PE changes, the price to earnings ratio or the dividend yield might change. Look at that in comparison with real estate. Real estate, you bought 1,000 square feet house. What can change to give you returns? Only the price per square foot. Can the number of square feet available in the house change? No. Nestle sold 100,000 units of Maggi this year. It can sell 110,000 units of Maggi the next year. Real estate, you cannot do that, right? For you have only one axis or one lever of returns. So in my view, so in the long term, equity returns will always trump real estate returns because of this. Because we have 3 or 4 levers to actually get us
And
returns.
one more thing is that given the tax benefits that are made available again for this real estate properties, obviously the shift will be towards equity market from the real estate market.
I think tax is one part of it, but I think fundamentally there's a better investment opportunity. Fundamentally, it's a better opportunity. I think it's, let's face it, the most, in India at least, the most wealthiest of people have come from owning businesses. They've not come from owning real estate.
One challenge that investors would face when they use financial information which is published information vis-a-vis unstructured public data, as you pointed out, those are all historical. We know data up to today. We don't know what's going to happen tomorrow. And that's where people are really grappling with the problem.
Yeah.
See, nobody knows unless you are an astrologer. He also makes mistakes. So, how does how do we use intelligence, artificial intelligence, natural intelligence to reasonably guess the future of the industry, product, geography, market to take investment decisions?
I think the framework which we went about, which is the Porter 5 Force framework, it actually gives us a very good clue on what is likely to happen in the future. And why is that? It tells you what are the competitive pressures that are happening to any industry. Now, if you analyze that well, what it tells you is that it tells you what is the ability of that business to generate enough return on capital. Is this business generate enough return on capital? Let's say you go to a business which is mom and pop, which is just a simple, what should I say, for want of a, let's say an undifferentiated business, which is, let's say which is making some small, automobile part, right? And there are, let's say, 100 suppliers who can do it. There is no competitive advantage. Will he be able to increase prices? That's the question, which is right. Bargaining power of customers is very high. He will not be able to increase prices. Will he be able to, negotiate with, let's say, if the steel price increases, will he be able to negotiate very well with the guy on the other side? Again, no, right? So he will have to pay the price increases on the steel side, but he may not be able to pass price increases to the customer. So he is going to get squeezed. Right? Businesses which are getting squeezed always end up in the low return on capital orbit, and that is a recipe for disaster, right? And if you are in a orbit where the industry forces are going to push you or squeeze you to earn lesser and lesser return on capital over time, you're always going to be throttled. So that's the first thing. So establish what forces are acting, and like the analysis that we did for the credit cards, you will be able to understand very fairly with a fair amount of confidence. And I think we should all believe that we are only humans, we can make mistakes. Yeah, we should, when we think about something, we can't say we are 100% sure credit cards will be there. I think in my mind, I will say, I can say with an 80% confidence interval. So one is to say that there's a probability. The other is use these forces too. The second part is growth. And that's a very, there are two, things to this problem, investing problem. One is return on capital. What is the return on long-term return on capital of the business? The other is what is the growth that is likely to see. Again, it's only a crystal ball gaze. The fact is, do we have the drivers? So let's give you an example. Let's say you're looking at two-wheelers and how is two-wheeler sales? Now, 2-3 lead indicators can give you an interesting data point. One is to say number of people who took driving licenses. It's a lead indicator. And you see that growing. If the demographics are changing, those are things which actually are likely to drive demand. So a little bit of, you need to take 4 or 5 data points, and which is the beauty of external data, because it is not what the management is saying. It's not based on financial data. You're able to get 4 or 5 data points. I'll give you another example, which I think we use, which is when, I think way back in 2000, for instance, when we wanted to look at the Mahindra tractors as an interesting opportunity, you were actually able to see what was happening on the agri side, what was happening to, reservoir levels across the country, acreage, everything actually kind of came together to actually build this growth. And that was a time when the entire auto sector was actually under the doom and gloom phase. But there was one shining spot within the auto sector. So you, just by using 4 or 5 data points, and they can go wrong, and it is only the past, you can't know what is the future. Who knew COVID will happen, right? And that is what we need to use. And that's why there is a science, which is the data. Have good data will give you more confidence. The art is the estimation, and I think the humility to say that we can get it wrong.
Yeah. So very interesting talk, sir. Especially the parking lot coverage by but I'm just going to ask with reference to the U.S. economy as an analogous thing. So there's this concern that this private equity which is making the thing dark. Like I'm reading like 20% in 2023 of the U.S. thing. It's private equity is coming in, so that's like dark. You don't really know how they are playing. That's one question. The second thing is I'm also concerned about these people like Bridgewater, the Dalio case, So he claims he has a big quants division, but ultimately it wasn't really the quants, but he was like, if you read the report, and he stepped down also. So it's not just the quants. It's people are influencing policy decisions. You don't know who's the owner of that.
Yeah. So see, that's be hard. So to the first question on is private equity bad for the market, the US market? I come from the industry. I've been in the industry for a long time. So I would say that having a large investor is always good. There is nothing like having a large, investor who actually is interested in the long-term return or the long-term improvement of the business. Yes, there are cases where people have stripped assets in the US. It is in the US markets, it is viewed negatively. But I think at least in the Indian markets, I can tell you private equity has actually helped, some of the businesses actually grow and find value. And I think that's the truth. I think the second example you're alluding to is, was it insider trading? Did people push policy to actually, happens all the time, right? Which is, he talked about Harshad Mehta. I think this will happen all the time. And how do we protect ourselves? We want to protect ourselves from making foolish decisions. And if we are small-time investors, if we get to Ray Dalio's size, great, right? And we will want to push policies. But let's say we are not in that game, right? And the only way we can do it is to be know the data, and have that, what should I say, the mental makeup to say, I walk away, right? And there's a lot of times when, prices are very high. If you don't find a single investment opportunity, are you ready not to invest? And that's a very, very important question you have to answer for yourself. And that, I think, is perhaps the most important makeup that an investor needs, right? In addition to being able to decipher the data, etc., if there is not a single opportunity, we don't invest. So all the way from 2006 to 2008, when I was at Bearings, we didn't make a single investment. That was the go-go years of thing. We couldn't find one investment opportunity that we were convinced that could actually make money. The 2008 crash of Lehman happened. Thankfully, we survived it because we had not made a single investment, right? And we had dry powder or enough money to actually make investments post that. That's
Sir, the interesting point is you have finished with the Warren Buffett quote. The audience may not be. Warren Buffett never uses an Excel sheet for investing.
yeah.
Okay, with respect to technology. My second point is related to your context relating to SBI cards.
Cards. Okay, I'll take cards. No specific investment opportunity. We'll talk cards. Yeah, go ahead. Please ask.
Okay. So
Yeah.
let us keep
Yeah.
cards as it is. Okay. So if you look at it, we always look at the industry growth rate as it is. If you look at the credit growth in India, it is about 10%. But if you look at the personal loan growth in India, it is more than 25% for the last 2 to 3 years. That's why RBI increased the weight. And if you look at the TransCibil scores, which you haven't alluded to, although the scores are not as robust as FICO scores in US, which is the market which we track, and the data sanctity is not there. If you look at it, below the sum of 50,000, the delinquency rate is about 3.84 compared to 0.50% for the loan growth of loan above 50,000 rupees. So the RBI has recently published a research report, which is a data point which clearly elaborates that the credit card risk is increasing and more people are getting delinquent, okay, charge off rate.
Sure.
The third point which I want to allude is with respect to, as you have focused upon Fisher, Buffett and Benjamin Graham with respect to it, but I am quite surprised that you did not allude to Charlie Munger, who recently passed away.
Charlie Munger, Buffett's partner.
Okay, with respect to psychology of human judgments, because most of the things which we talk about, Baiju and other things, relates to what we call it as a confirmatory bias, which you alluded to.
Correct.
You cannot go away from the group. If I want to take an independent decision, I need to be very strong with respect to the data which you are saying. My final point is with respect to Indian market. Recently we were checking about the data. If you look at the whole universe of listed companies, only 20% are large corporation where information is available. 60 to 80% is small and mid cap, where you won't get much of the data. In that case, what is your suggestion?
Super. So what was the first question? That's the only one which I forget now. Cards, Munger and small mid cap. What is the first question? Oh, okay. So, okay. Good. Yeah. Absolutely. That's Buffet, right? We are humans, right? And that's the truth, right? We are humans. I think I'll tell you why I think it's sometimes important to use a spreadsheet. And I do use a spreadsheet, a fairly simple one, and I do use it systematically. And I will allude to Kahneman's book, which is the System 2 thinking, which tells you to systematically look at growth. If you're an investor, as an investor, what do you want to do? You want to look at growth, you want to look at ROE, and then value the businesses, right? Now, it's possible that if I don't have all of them together in one single framework, if I like HDFC Bank. I might like when it's led by Aditya Puri. Might not like it when I'm led by somebody else. I will start influencing the model or the valuation of the business, right? And it is human to do so, right? Some people are wired in such a way that they're able to say that they don't need to make these mistakes. For people lesser mortals like us, I think it is important to actually use a spreadsheet so that we don't make the same mistakes, right? So system 2 thinking, to enforce system 2 thinking, which Kahneman says, which is systematically think whether price and value, is the price in the which you are seeing in the market substantially lower than value, is something that helps, a spreadsheet helps. That number one, which is why I still use a spreadsheet, right? The second one, you asked about cards. I think different data points, right? RBI put out a report, but RBI's own data, and which is what I took out, says that the total credit card outstanding in the market as a percentage of total credit card spends in the industry has not moved since 2018, right? And this is month-on-month data, right? There might be some small movements from one, 90-day bucket to the 180-day bucket. There might be some local and small issues, but at an overall level, it's not actually impacted. So that's the next point that I wanted to make. The third point was on Munger. I think unfortunately I've actually read most of the people who have talked about, be it Phil Fisher, be it Warren Buffett, even a study in Scarlet. What I've not read is the Poor Charlie's Almanac, which I promised to read over the next year so that I can actually make a statement from his book. And the last one was Almanac. Sure, I will do that. And I will definitely do that. And I'm sure. Last one was, sorry. Mid-cap. So you'll actually be surprised. It's very, very interesting. Even the mid-caps actually give you phenomenal, there is phenomenal data available once you start look at, public market sources. You will be astounded. So I'll give you an example. So if you take the insurance regulator and the data that they put out on premiums, number of agents, number of people, the entire market cap spectrum, whether you're private or public, is available. Right? The auto data, which is there on, let's say Vahan, for instance, again a public data source maintained by the Ministry of Road Transport and Highways, tells you data on how Ampere is doing. It's Greaves Cotton's branch, less than 1,000 crore if I'm last, I don't know what's the market cap, but don't remember offhand. But it's actually something that you can track. So whether mid cap, small cap doesn't matter, but I think the tail is getting longer and longer and people are actually getting more information. If you ask me, on the top 500 companies, which constitute perhaps more than 95% of India's market cap, I think you will have a fairly decent coverage of, good quality public data. Yeah, there will be some places which are not covered. You just hope that over time, they get filled in, right? And that's really the hope that we are praying. All that is fine, but the money is ours, right? Cavi tempter, buyer beware. It's a buyer beware business. Nothing we can do. You bought a property in which there was a double document. You can do whatever you want. You're not getting that. You have to pay the lawyer. You have to get the right this thing. Otherwise, you're going. Perhaps your grandson or your granddaughter will get the judgment from the court, right? It's not going to happen. Sorry, sir.
Can I ask a question? Excuse me. Yeah, I have a question, and thank you for the presentation. I just wanted to know, in terms of an investor, a person like me or someone perhaps even more or less educated, how do we actually harness the purpose? I mean, I can understand that there are public data points which are very important. So I've got two questions. One is, as an investor, how do I get this mind-boggling number of data points? How do I kind of crystallize it? I'm not talking about magic pill, but how do I crystallize it to get some kind of an informed decision? That's one. Second is, how do I look at dissonance in data? For example, someone spoke of personal loans. RBI has also done a study that the growth of personal loans is correlated to the growth of equity markets. Because of the arbitrage, people are taking personal loans at 12% and investing it hoping to get a return of 22%. It's not actually getting into consumer finance. So how do I look at these kind of confounding data points to get an informed decision. And what does Thorough do on this space?
So I think that's our business. We try to make these data points easily accessible to a vast majority of audience. That's what we have done. The owner's exercise which I talked about, take a snapshot, build it over time and make it available in a ready format is what we have done. Sorry. Okay. Is what we have done, right? And so we have made it very easy for people. That's what our business is and that's what we do. That's number one. So you can actually go to www.thorough.com, have a look at our platform. You can actually log in, you can actually look at it. That's one. The second question which you asked is confounding data point. 100% yes, right? You will find two data points. That's the beauty of external data, right? It is not, all data signals don't point in one direction. It forces you to say what is the confidence you have in your judgment, right? If you actually are able to see that all data points are pointing in one direction, you can actually say that I have a 80% confidence. If you find two data points, confounding each other and only, you're less convinced, you might say I ascribe a 30% chance of this outcome. So this is the calibration that you need to do yourself a little bit, and that's where the art of investing comes, which is to say that is a mental model or the makeup that you come with, which is to say that, how do I calibrate my probability that a certain outcome will come out. Yeah. So I think the simpler part, which is the data, is available on Thorough. I think the judgment, which is to say what probability I ascribe, I think is left to the individual investor, right? Yeah. Sorry.
Does your system have any evaluation of the analyst or the financial influences?
No, we don't.
Often they're displaying.
Yeah. So I think we're a big believer in data speaks, and data speaks, and especially if data is collected without having a view on what you want to analyze. We think it's a very, very, very powerful tool, and in fact this is called, I think it's a paper in Nature which comes, I think they have a term for it, it's called outcome blindness, right? I don't know the outcome of my research, but I collect the data, right? You take the example of that photograph which I talked about, the night sky. When the first person did the long exposure photograph, I don't think he knew what was going to come out. He saw circular trails and he said why, and then he came up with the answer to say that the earth is spinning on its axis. Very similar, right? If you collect data and then you do the analysis, you probably will get a very, very, very good result. Does that answer your question?
Yeah, that answers actually.
Yeah.
But it is obvious that whenever we get data from analysts, most of the time the result is otherwise right. So why don't we have a system in publishing the ranking of the analyst or something, or how much you can trust them? On a scale of 1 to 10.
Fairly good question. It's a good business idea. I'm sure somebody will crack that, which I'm sure will happen. I still go back to the same point which I told the other gentleman: buyer beware. Right? It's your money. It's not the analyst's money. Right? You have to make the judgment. The analyst can assist, take it with a pinch of salt, but it's your money. That is the only thing which I can. I think many of the learnings that we have about the real estate market, while may not be the best investment over the long term, can actually be applied very easily. When we have to buy a house, what do? We go to check the location, look at the neighbors. They have a dog, don't they have a dog? So many questions, and then is there a good school nearby? So we're taking a good call on what is potential. But when it comes to stocks, your friend told you, so you actually pull the trigger and hit you. That is or an analyst told you. Why? Actually do the analysis. And it's fairly easy. I'm saying if you just understand the business parameters, it's fairly easy. You will be able to do the exact same analysis that you're able to do in the real estate markets to actually do in the equity markets too. And I think when I said investing, I think I talked about equity investing only. I should perhaps have made that caveat at the start at some point in time.
By the time we analyze the market or the data, when the share be sold,
yeah, prices move very fast, right? And that's, but having said that, markets overreact on both sides. They both overreact on optimism, they overreact on pessimism also. And I think a good case and example could be as to what happened during COVID, right? the entire stock market went down. Businesses which were otherwise very strong businesses were completely available very, very cheap. So you have to make that call to find out whether the price is overreacted or the price is underreacted. On which side is it reacted? Yeah.
I mean, we can keep going on. This subject has no finish line. It's only keeps going on and on. I remember even 10 years back in an investment sort of a seminar of this nature, lots of questions came. People are really concerned about how. I'll give you a very simple example which I underwent way back in 1986. In my first job, I was working in Sundaram Finance, and my first job was to do a comparison of all the competitors manually. Income, expense, PBT, stock on hire, etc., and arrive at some ratios. The chairman of the company was late Mr. T.S. Santanam, who had a great fascination for numbers and interpretation of the numbers. So when I took it to him, you've done all this is the comparison, data is fine, information is fine, ratio is fine. Did you find out in each company's what was the income recognition policy and put all of them on an even keel and rework the numbers? Question number one. Question number two, he said, did you go through the notes on accounts to see whether there are any contingent liabilities of large proportion not provided for? If you provide 50% of them and rework the profits, what are the numbers? Why I am telling all this is, we can get all the information as informed decision makers and make decisions. But we will also have to use that information, make the tweaks, make the adjustments to some of these niceties around the numbers. That is very critical. And some of the analysts' reports will not point out. Today, much of the information which is there is patently, outwardly looks good. But what is hidden is very, very deep, and you have to go through it. So as Karthik very rightly pointed out, this is the tip of the iceberg. We'll have to keep going deep. It is our own decision-making process. You can't delegate it. You own the decision. So you have to do research, you have to do your own analysis and make your own decision. Don't blame others. When you succeed also, you sort of take credit. If you don't succeed, you are responsible, not anybody else. But thank you, Karthik. You have made a very, very insightful presentation. And yes, all of us will keep learning as we keep going in our investment decisions. I must thank the audience also, a fairly large audience present here. And the type of questions today, if you look at the quality of questions, they are like analysts. I think he raised an analyst question. The gentleman here also raised very interesting points. So it really augurs well. And thank you all of you for supporting the Chennai International Center activities. There are more events in store. It will be informed to you. Thank you, Karthik, for making time for this. Thank you very much.